Welcome to Real Estate is Taxing, where we talk about all things real estate tax and break down complex concepts into understandable, entertaining tax topics. My name is Natalie Colati. I'm your host, and I am so excited that you've decided to join me. Hey everyone, and welcome to today's episode. If you have heard me speak somewhere or if you've followed me on social media, then you will know that today's episode topic is something I am incredibly passionate about. The reason being is that this is something that impacts an incredible amount of Americans, whether or not they are a real estate investor. What I want to talk to you guys about today is the 121 exclusion, or the primary home sale exclusion. So I want to start by giving you guys a brief recap on what this is, and then I want to walk through the 5 most common mistakes I see that could be costing you thousands of dollars in tax if either you or your tax professional don't understand this. So, starting with the basics. The 121 exclusion, or primary home sale exclusion, says that if you own and occupy your primary home for 2 of the most recent 5 years, when you sell it, you get to exclude a large amount of the gain. It's important to note that this is actually based on the number of days. So it's not based on a calendar year or a ballpark based on the month you moved in and the month you sold. It is the literal number of days that you own and occupy. What this means is that when you're hearing 2 of 5 years, what you need to do if you are considering selling a primary home is that you need to look at the day you bought it and moved in and the day you would be selling it and move out. It is actually 730 days out of 1,825 days. So if you have a qualifying move-in and that becomes your home on June 1st, and then you go to sell it 2 years later, but you sell it on May 15th, you will not reach that exclusion. I have seen people think that they are going to have their gain fully qualify under this, and then literally miss it because they moved out and sold the primary home a couple weeks too soon. You do not want to make that mistake, so ensure that if you are planning to sell a home that you have used as your primary, that you nail that down to the literal day. Another common thing that I'm not sure people are aware of, but is really important for you to know, is we often also hear that this exclusion, right, you own and occupy for 2 out of 5 years, which we've just learned is actually 730 days out of 1825 days, gets you $250,000 of gain tax-free if you're single or $500,000 if you're married. That is typically the case, but something people don't consider is it's not technically related to being single or married most of the time. Each legal owner who meets the qualifying terms of ownership and occupancy qualifies for their own $250,000 exclusion. What does this mean? This means if you and 2 of your siblings buy a house together and live together in that house for more than 2 years, when you go to sell it, if your gain is above $500,000, you can still exclude it because each one of you has your own 121 exclusion. So in theory, if 3 people all legally own a primary residence together and they all use it as their primary residence for 2 years, when they go to sell it, up to $750,000 of gain could be excluded. That is because the $250,000 excludable gain is per legal owner. So those are kind of the basics of the 121 exclusion. You own and occupy a home for 2 out of 5 years, but the caveat is it's to the day, be cautious. And you get $250,000 of excludable gain per legal owner. So you can actually exclude more than $500,000. This is a tax provision that is incredibly powerful. Very few ways that you can make $500,000 and not pay any tax on it. In conjunction with that, there's a lot of nuance that relates to this section of the tax code, and there's a lot of pieces that are often misunderstood. What I'm going to dive into now are the 5 most common mistakes I see related to the 121 exclusion. There are absolutely more mistakes than this. There are absolutely more ways I've seen this screwed up, but these are the 5 that you need to know to make sure that you are not paying tax for no reason. And most of these mistakes I have seen from both tax professionals and taxpayers. So some professionals even get these mixed up. So we're going to dive into it and make sure you know every little detail to avoid these 5 most common mistakes. The first common mistake, or the first common misunderstanding, is that if after you use your home as a primary home for at least 2 years, if you convert that to a rental, you move out, you decide to rent the house, that you by default have non-qualified use. The tax code defines non-qualified use as any time that house is not used as your qualified primary home. So it is true that if you lived in it for 2 years and then changed it to a rental, those years when you're renting it, it's technically not your primary home. It wouldn't be your qualified main home. However, there is an exception in the tax code. There's so many exceptions. So there's an exception in this code provision that says anytime the home is not being used as the primary residential home, it's non-qualified use, except if that time occurs after the most recent time that you used it as your primary home. What does this mean? So if we think back to the basics, to sell your primary home tax-free, you have to own and occupy for 2 of the most recent 5 years. What that effectively means is the day you go to sell, there's like a 5-year look back, right? They're looking back 5 years. And as long as at any time during that chunk you had owned and occupied it as your primary home, there's a good chance you can qualify. Because this exception is time after your most recent use as a primary, what this means is that if you have lived in this home for 2 or more years and you convert it to a rental, you have up to 3 years to sell where you can still receive your full 121 exclusion. Because it is a 5-year look back, you have lived in it at least 2. And there's that exception that any time after your most recent use does not count as non-qualified. This is something I have seen multiple tax professionals get wrong. So if you live in your primary home, you convert it to a rental, and then you sell it within a 3-year window, you still qualify for the entire 121 exclusion. There's no prorating, there's no part that's non-qualified use where those years are taxable. You qualify for the full exclusion. The only thing you would need to pay is you pay back that unrecaptured $1,250 depreciation, so your straight line depreciation you have to take on the house for those years it was a rental. But there's not non-qualified use. I see this mixed up all the time, and it's resulting in taxpayers paying tax when they literally do not have to. So that is my first warning. This is the first thing that I think is so important to understand. The next mistake, or the next common error, is almost the inverse of the first one. This is the concept where people seem to have, they've gotten it in their brains that the whole gist of this code is, well, 2 out of 5 years, you get to sell it tax-free, right? 2 out of 5 years, that's all you need. That's all you need. So I've seen a lot of people think that if they've had a rental for 20 years and it has a ton of gain built into it now, right? If they sold it today, they'd have a lot of gain. The value has gone up tremendously. And they think, oh, well, I will just move into it for 2 years. And then I meet that criteria, that 121 2 out of 5 year rule. And now I can sell it tax-free. That's my plan. This is the circumstance where you do have non-qualified use. Again, non-qualified use. This became a thing in 2009. So any houses from prior to that, any rental time prior to that, we don't look at. But after January of 2009, any time a house was a rental before the time it was your primary, that is non-qualified use. So what this means is that if you owned and rented this house for 20 years, and then you move into it for 2, thinking you can exclude your full gain using the 121 exclusion, that's not the case. When there's non-qualified use, what happens then is the gain that is proportionate to the amount of years it wasn't your qualified primary, the gain related to that number of years is in fact taxable. So in this example, 20 out of 22 years worth of the gain is going to be taxable. It cannot be excluded under the 121. Something else that people kind of misunderstand with this is their thought is that, okay, well, of those 2 years left that qualify for the 121, they can exclude a smaller amount of gain, like it reduces the gain. That's not the case either. They still qualify for that full amount of $250,000. It's just that the amount of overall gain would have to be tremendous for 2 years worth of it to be under $250,000 or to get up to that point. So they can still exclude up to $250,000 worth of gain as long as the portion of gain related to only 2 years is $250,000. But this is where non-qualified use does come in. So if you have had a rental property for years and years and years, and you think to yourself that you can move into it, live there for a couple years and get to sell it tax-free, I will save you the U-Haul fees. Don't do this. Not going to help. Now, if you move into it, right, like say you've already made this mistake, you're in your car, you're listening to this, and you're like, crap. It does get better the longer you live in it because this is a ratio, right? So if you've owned it and rented it for 20 years, and then you move in and live in it for 20 years, well, now half of the gain when you sell qualifies for the 121 exclusion. But just know, the recap on non-qualified use is if it's your primary first and you rent it for no more than 3 years, there is no non-qualified use. You can sell it and get the full 121 exclusion. You just pay back depreciation. If it starts as a rental or starts as a business use property and then you move into it, there will always be non-qualified use. That means the number of years that it was rented out of the total number of years of ownership, that portion of the gain is always going to be taxable. The third common mistake that I see all the time related to the 121 exclusion is understanding when and when you do not have to prorate it in relation to a house hack. Now, when we talk about house hacking, this term gets used interchangeably for someone who is either living in a single-family home and they essentially have roommates, right? You're living in your primary bedroom, you're renting out the spare 2 bedrooms. This term also gets used for this circumstance where maybe you bought a duplex or a fourplex. You're living in one unit, you're renting out the other 3. For all intents and purposes, using the same term for both is fine, right? We're doing kind of the same thing. For taxes, there's a much bigger difference between the two. Like I was saying earlier, in a lot of the tax code, there's often these weird exceptions. They love to throw something in there, just as a little test. So this is where another exception comes into play. Normally with the 121 exclusion, it applies only to your dwelling unit. This is literally within the 4 walls of a separate unit that you occupy. So if you are house hacking and you are house hacking a fourplex and you live in 1 unit and you're renting 3 units, when you go to sell, only 1/4 of the gain, assuming all of the units are the same size, only 1/4 of the gain will you be able to exclude under the 121 exclusion. A lot of people think because they're living in the overall building, they can sell it and exclude the whole thing. It's not the case. It is literally only your unit, your legal dwelling unit. So the flip side to this and the exception where we do not need to prorate, where you can still get the full 121, is if the space you are renting is within your dwelling unit. So in this circumstance where you're the house hacker who is renting your spare bedrooms, when you go to sell that house, you will still qualify for the full 121 exclusion. As long as the space being rented is within the same legal dwelling unit that you are occupying as your primary, it still qualifies for the full exclusion. Again, the only thing you pay back is the depreciation. So 2 strategies, same name. We call them the same thing. We talk about them interchangeably. But it's important to be very aware that whether you're renting rooms in your house or whether you are living in one unit out of like a duplex or a 4 unit, the impact is going to be different. Renting rooms in your house, you can still qualify for that full tax-free primary exclusion. If you are living in a small multi-unit property, only your legal dwelling unit, only the proportion of gain proportionate to your unit square footage out of the total of that whole property, only that piece is going to be excludable. Now, the other 3 units, those will all be taxable when you sell, and you can utilize a 1031 exchange for the gain related to those 3 if you would like, but that's a whole different episode. But just know that when you're looking at house hacking, the type of property you're house hacking is going to impact what you can exclude under the primary home sale exclusion when you sell. So just something to keep in mind if that is part of your strategy. If your overall thought process is that you're not keeping this house long term, if you're planning to do somewhat of a live and fix and flip while you're house hacking, very different impact on if you are renting rooms in a house versus 1 unit or multi-units in a small multifamily. The next item related to 121 exclusion that I want to talk about for a minute because I think a lot of people also don't think about this one. There's a handful of kind of common statements about most things. But on this tax code, right, it's 2 out of 5 years. That's what everyone hears. And the other thing people say in relation to that is that you can only use it once every 2 years. And that makes sense on the surface, right? If you have to live in something for 2 years, then how could you do this more often than every 2 years? Well, there again is an exception, just like with a lot of other things. If you haven't lived in your primary home for that entire 2 years yet, if you've lived in it for, say, 1 year, and something comes up that requires you to move and sell, and it's an unforeseen circumstance. If you have to move because of a job-related purpose, if your job relocates you across the country, or if there's a medical reason, if you have to move to a different climate because your doctor says you have to, or if you're moving for treatment, or if it's just something unforeseen. One of my favorite cases about this was a couple where they became pregnant and they had just bought a condo and then they ended up having like triplets. And so that was an unforeseen circumstance because the court was like, sure, this 500 square foot condo is not designed to house 5 people. We get that. So if you meet one of these unexpected circumstances, like you're not just selling because you want to, you're selling because something major changed in life that you hadn't planned for, then you are allowed to use a partial exclusion. So what this means is that if at the time this exclusion comes up, like if you have occupied it for 1 year instead of the full 2, and your job says, we need you across the country, we're sending you there. What this means is that instead of the full amount of a $250,000 exclusion, if you're a single person, you're going to qualify for half as much. So you would get $125,000 exclusion. A lot of people are fairly familiar with that concept. And if you're not, it's a good one to know. Anytime you're selling a primary home, think about why you're selling, and if there's a chance it falls under something that you weren't planning for, you could qualify for this if you haven't lived there for 2 years. Always worth looking at, always worth digging into it a little more. So most people are familiar with the idea that if you have to move before 2 years, you can get that prorated exclusion and you can exclude just a smaller amount of maximum gain, right? It doesn't mean your gain is by default partially taxable. It just means the total amount of gain that you can exclude is less. And it's based on the ratio of 2 different things. There's actually 2 options for this, and this is the part people aren't familiar with. So what most people are familiar with is what I just mentioned, which is the number of time you have occupied it out of 2 years, right? So if you'd been there 1 year, you get half as much. If you'd only been there for 6 months, you would only get a quarter of the full exclusion. So it prorates that way. There's a second test you can use. So you have to use the smaller of these two tests, and that is either the number of months that you've occupied it out of the 2 years you were supposed to, or you can also use the time since your most recent 121 exclusion. The reason I mention this is something I have seen incorrect by tax preparers most commonly. I think they don't always realize that there's this kind of secondary option because we've had these rules drilled into our head. So the core rule is typically you can only do this once every 2 years, right? But if you are moving for an unforeseen reason, you can essentially have this come up more than once within a 2-year window, or even twice in the same year. Let's say January of the year, right? You sell your primary home that you'd owned and occupied for years and years, and you buy a new primary, right? You sell the first one, you get the full 121 exclusion, it's tax-free, all good to go there. Then in November, 11 months later, your job says, oops, sorry, we're shipping you across the country, and you have to get out there next week. You weren't planning to sell this new house, you just bought it. So this is a case where you would technically have 2 exclusions in the same tax year. You would have 2 reported on your tax return for that same year. That first 121 exclusion would be the full amount, right? That first house you sold, you'd lived in for years, you get to sell it, no problem. The second one qualifies for a reduced exclusion, right? For 11 out of 24 months worth of an exclusion. And because you have done a 121 exclusion pretty recently within the same year, that is the test you're going to use. So in this case, it would be a look back to that last most recent exclusion. A lot of software tells you can't do it because on surface level, you can't, unless there's this unforeseen experience. And then you might have 2 121 exclusions within the same tax year. But again, because most software by default doesn't just let you do it as kind of a safeguard, a lot of people assume they can't do it and they pay the tax. If the reason you are selling the house, the second house, if you've done a 121 exclusion pretty recently, and now you're having to sell your newer primary home, if it falls under one of those unforeseen circumstances, where it's either job-related or medical or just something you hadn't planned on, you can indeed exclude the gain on that second property. It's just going to be a reduced maximum limit. But there are cases where you will have not only more than one within a 2-year window, you could even have 2 121 exclusions in the same tax year. So in summary, if you own and occupy your primary home for 2 out of the most recent 5 years, which is actually 730 days out of 1,825 days, you get to exclude $250,000 of gain per legal owner. So per legal owner who meets that qualification. And past that, for common mistakes to be cautious of, is if you rent your primary home after you move out of it, and you rent it for no more than 3 years, you do not have non-qualified use, and you can still qualify for that full 121 exclusion when you sell. The flip side of that, if you've had a house that started as a rental and you decide to move into it for 2 years, that does not get you a tax-free sale. That does not get you the full 121. Any of those years, it was not a primary home before it was. The gain related to that number of years will always be taxable. The exclusion related to rental use, different for house hacking if it is rooms in your primary home versus different units in a small multifamily you occupy. If you are renting spare bedrooms in the same house in which you live as a primary, you do not have to prorate that gain. The full gain still qualifies for the 121 exclusion and you can sell tax-free. However, if you are renting 3 units in a fourplex and you are living in the fourth, then only 25% of your gain would qualify for the 121 exclusion. And the last note is that you can only do this once every 2 years unless you had an unforeseen circumstance. If there was something you didn't plan on happening, you're selling for a reason that you hadn't intended, your job moves you, there's a medical reason, something just comes up in life, then there is a good chance that you can qualify for a reduced amount of maximum exclusion, even if you have used the 121 exclusion within the past 2 years. So I know this is a lot of information, and if you followed me last year, I did do a 121 days of 121, where I posted new content about this topic specifically for 121 days in a row. I'm going to do something similar this year, so keep an eye out for that. And again, I want to let you guys know that before you do anything we talk about in this show, you should talk to your tax professional. Well, I am a tax strategist. I am not your strategist. I am so appreciative of you guys joining me today. Remember to subscribe, and I will talk to you again next week.